Well, thank you for this opportunity to present this work. This project is titled Cyber Risk and the U.S. Financial System, a Pre-Mortem Analysis. This is joint work with my colleagues from the New York Fed, Thomas Eisenbach and Hannah Kovner. So I want to start by kind of motivating the question here. Cyber risk has quickly risen as a major factor of systemic risk. One of the features that we know is the fact that financial institutions appear to be attacked in much greater numbers in terms of magnitudes than the typical US firm. And this is naturally because of the nature of the information that financial institutions must safeguard. Now, it's also has quickly risen to one of the top perceived risks to financial stability, and this is shared both by the industry and regulators. And yet, there are huge challenges to rigorously studying cyber risk. One of the issues is that we still do not have a clear consensus on how to classify cyber events. And this is already going to strictly limit the ability for us as researchers to have a comprehensive data collection on past incidences. Now, in this paper, because of this, we're going to take the approach, given that we don't or have not yet experienced a major cyber attack, to examine what if a cyber risk eventualizes in the system and potentially impacts the financial system. So specifically, we're going to try to tackle this question of what the level or the extent of vulnerability is of the US financial system to a cyber attack. Specifically, how might a cyber attack be amplified through the financial system? Now, to this end, we're going to start by identifying familiar and unique features of cyber risk and theoretically think about or examine how cyber risk might be different from other sources of risk that we have a much better understanding of. Now, this is going to broadly assist with us building an empirical framework to analyze cyber vulnerability. And based on this, we're going to measure the network impact through hypothetical scenarios that might happen in the financial system. So let me go through a little bit about how cyber risk might be special or familiar to traditional forms. Now, cyber risk is a special type of form of operational risk. And much like any other form of operational risk, this can lead to a potentially systemic event. So you can imagine for a canonical operational event, if it is severe, it can impair the institution's ability to operate normally. And this can lead to a spell of illiquidity. Now, if this illiquidity continues to be strained, then this can eventually devolve into an insolvency event. So much like this, cyber risk can be, just like any operational event, a catalyst for illiquidity to begin and can roll over into an insolvency event. Now, having said that, we want to highlight two important features that might be unique or special to cyber risk. And the first is the endogeneity of the cyber event, or the intent, the fact that the cyber risk is arising from an attacker's goal or objective. And the second is concerning the level of uncertainty and lack of information or knowledge surrounding a cyber attack. So let's talk about the first aspect. The fact is that a cyber attack is driven by the intent of an attacker who is deciding on both the target and the timing of the attack. Now, while a lot of attacks that we have experienced historically have been attackers who have been monetarily driven, we're particularly concerned about the potential for the attacker to be malicious. And in this case, the attacker's goal may not be monetarily driven, but in order to maximize damage and disruption within the financial system. Now, added to that, because a cyber attack is strategic, this can lead to a circumstance where there's a high level of uncertainty. In particular, attackers may gain access to a system or data and remain hidden or dormant until they assess that the timing is right to inflict the maximum damage. And this contributes to a unique feature of cyber attack, in which case the attack itself, the timing itself, is geared by the objective, not necessarily like other forms of operational events. Now, second of all, cyber risk is going to be surrounded by heightened uncertainty and lack of knowledge. And this is an important feature, is that in this current stage, not only do we have a lack of common knowledge or understanding of cyber risk, but as the event unfolds, this can lead to an exacerbating the asymmetric information within the system. In particular, there can be a systemic impact through the technological connections or similarities between financial institutions. And as I mentioned before, even within a single institution that is affected, this can exacerbate runs as other business lines of the firm may start to become impacted due to the concern of the underlying customer or clients that are otherwise not necessarily affected. Now, a final point that we want to make is the fact that networks, however inefficient they are naturally structured to be resilient to sharing liquidity risk. And this is a fundamental feature about financial networks. Now, as opposed to that, cyber risk is not necessarily going to coincide with a resilient network structure catered towards liquidity risk. And as a result, there's really little that we understand about how cyber risk may spread in this particular network. Now that motivates the core of our paper, which empirically investigates how a cyber attack may be amplified and can lead to financial instability. Now our main setting is going to be in Fedwire. So Fedwire is one of the main wholesale payment networks in the US, and it has very attractive features or an environment to study the potential for a cyber attack. Now, first of all, payment networks have been a key focus for where cyber events may have a systemic impact, and that's for two reasons. First of all, historically, we know that there is a lot of strategic behavior in wholesale payment networks, and they heavily rely on the coordination of multiple types of institutions and participants. As evidence, we've seen operational outages, and in the case of 9/11, the aftermath of 9/11, huge changes in the behavior of banks, reflecting the fact that they wanted to preserve liquidity. And this led to huge disruptions in the flow of payments. Now, more recently, as we transitioned into a different environment with ample reserves, banks have also stated that management of reserves and liquidity is a key factor or determinant in terms of how they operate payments as well. So given this, there is a potential component of coordination breaking down in wholesale payment networks, but also as a starting point, it can lead to huge potential spillovers. So Fedwire, for example, is important, a vital function in order to have financial markets and institutions provide day-to-day services, critical for the OTC markets, prime brokerage, and custody. And in addition to that, a disruption in the payment network can lead to real economy effects, for example, through payroll. Now, from a researcher standpoint, a huge important feature of Fedwire funds is also that we can actually analyze the complete network of interactions, including detailed granular payments. And this is going to allow us to measure the network impact without having strong assumptions on how institutions might be affected. So to this end, I'm going to go into our framework for assessing cyber vulnerability. Now, we're going to focus primarily on trying to estimate or measure the single-day impact of a cyber attack. The reason why we want to focus on a single day impact is that allows us to consider, even in this isolated time period, what the magnitude of a cyber attack might be, considering the fact that over a multi-day impact, there's likely going to be government intervention. Now, first, we need to assess or classify a subset of institutions that are going to be privy to this cyber attack. We're going to refer to institutions who are directly attacked and impacted as shocked institutions. And the underlying assumption is that at the beginning of the day, they are attacked, and as a result, they're able to receive, but no longer able to send payments. Now, this is consistent with the institutional structure of many payment networks. So payment systems typically require a sender to send a message to the system in order to make a transfer from the sender to a receiver. And what this means is that a shocked institution, while unable to send out payments due to an impairment or in terms of their systems, will still continue to be able to receive payments. Now, in this particular instance, we have the direct impact of a cyber attack. First of all, the shocked institution, if it is no longer able to send out payments, is naturally going to fail to provide the payments necessary for itself and for its clients. Now, second, more importantly, is the fact that this shocked institution is now effectively going to become a liquidity black hole. If other institutions continue to send payments to this shocked institution, but this shocked institution is not sending out or releasing liquidity, this can lead to a huge dislocation in the distribution of liquidity within the system. Now, what's really important is then how are other banks reacting to the cyber attack? And we're going to examine two different scenarios in terms of assuming how banks might react. In the baseline scenario, we're going to assume that other banks' payment activities are unaffected. Now, two ways to think about the scenario is the fact that other institutions may have incomplete information about the arrival of the cyber attack. And secondly, may exhibit some inattention to delays in intraday payment flows, particularly in a world where reserves are not necessarily scarce. Now, having said that, banks may be very, very vigilant with respect to how they are managing their payments and monitoring their payment activity. In which case, in the second scenario, which we call the Cascade scenario, we're going to examine a situation where banks are strategically going to hoard liquidity in response to certain shortages that they perceive in terms of the flow of payments. So with this, we have a subset of institutions who are shocked or hit directly by a cyber attack, started soaking up liquidity. And this failure to receive payments from these shocked institutions may start to affect other institutions' liquidity position. Now, in order for us to understand this derivative impact, we're going to identify banks that are perceived or potentially impaired. We're going to define impairment as institutions whose counterfactual end-of-day reserves fall below a certain threshold. Now, in particular, for our scenarios, we're going to use a buffer around the time-varying target balance. So given the last 30-day average reserves, we're going to consider an institution impaired if its counterfactual end-of-day reserve falls 2 standard deviations below its 30-day mean. Now, in our baseline scenario, we're considering an environment where institutions are not necessarily responding to the changes in the payment flows. And in particular, a key set of institutions that we are interested in are the top 5 institutions by payment value. Now, this is a natural starting point for understanding which set of institutions might be particularly important for the payment network. Now here you can see here that the top 5 institutions by payment value are roughly responsible for 50% of the total payments within the system. And this level has been fairly persistent and steady over time. Now this reflects a more general feature of payment networks. First of all, it has a strong core periphery structure. And secondly, payments are highly concentrated in a select few of the core. So with that backdrop, we're going to consider a baseline scenario where an attack is successful on one of the top 5 institutions. Now, in this plot, we have all 5 of the institutions. And at any given day, we consider and assess the network impact of an attack on each institution. Here, we are measuring the total number of banks and the weighted number of banks, weighted share of banks that are likely to become impaired according to our definition following an attack on one of the top 5 institutions. In terms of the number of institutions, we see that 5 to 9% on average are impaired due to an attack on a top 5 institution. And when we weight this by asset size, we see that reflecting the fact that payment networks are highly concentrated, this effect magnifies by about 4 times, ranging from 20 to 50% of bank assets. Now, a different way to look at this is to look at what the empirical distribution of network impact is. So here in blue, we have the share of institutions per day and the weighted share. Now here you can see actually there's a huge substantial difference in terms of how we see the network impact once we take into account that larger institutions might be more likely to be affected by a successful cyber attack on a top 5 institution. Now this graded weighted share reflects this interconnectedness between the network and the high concentration of payment value. And this gray area here takes away or is net of the direct impact and only adds up the derivative impact. And you can see here that while the top 5 institutions are large institutions that do make a significant impact on the assessment of the network impact, so are the other institutions who are assumed not affected. So here, what we focused on is just taking into account the network structure and examining what the average impact of a cyber attack could be. Now, similarly, we could think that a cyber attack potentially has widespread spillovers to the real economy. And one way we can think about it is there can be a huge impact on core financial services and bank deposits. So we might expect that there's a high concentration of activity in key financial centers in the US. So we can tackle this by considering what is the geographic impact of the cyber attack. One way to do it is to use the market structure of the US banking system inferred from the summary of deposits. So for each institution at the county level, we take the deposit market share and we recalibrate what the network impact is by the measure of or the share of deposits that are likely to be impacted. And we use this to proxy for banking market presence. So this question here is, what are the impaired institutions' market presence in local banking markets? And maybe surprisingly, we find that the impact is widespread. So overall, we find that 23% of banking market deposits are impacted on average. And at the state level, we find that 5 states have over 40% of their deposits affected and about half over 20%. Now, as expected, we see a high impact in financial centers such as New York or Boston or California, but we also see a broader effect than we had anticipated. And this reflects the fact that even if institutions are not necessarily core in the bank, as long as they have strong ties to the core of the network, they are likely to be impaired as well. So these are different ways in which we can evaluate what the network impact might be. But as I alluded to before, one important feature of cyber attacks is the fact that there's this strategic component. So one tangible way we can think about this is to think about how a cyber attacker might try to pinpoint its attack to maximum damage. Now, given that an objective is to cause maximum damage, the impact then is going to be defined by what the attacker's information is regarding the payment system and the network structure as a whole, and the target institution. So one tangible way we approach this is to think about or classify what the attacker might be able to achieve given limited amounts of information. The first level that we can imagine is public information. Now, there's a lot of public information and research on the nature of the payment system. For example, there can be seasonalities, calendar effects, and market events that are driven by payment activity. Now, the second level is if the attacker is privy to private information regarding the target institution. For example, by accessing detailed information about the target institution's payment activity, the attacker may be able to pinpoint a particular day or a set of days that it predicts high payment value and thus a larger impact on the broader system. And of course, we can go further than that if the attacker were to have more private information, not just on the target institution, but the target institution's relations with other institutions and the network as a whole, it may be able to even do better than that. Now, consistent with this intuition, we find that actually timed attacks have the potential to have a huge impact. So here we're plotting the weighted share or the network impact, and here we've colored the days by non-seasonal or seasonal for one of the scenarios of the top 5 institutions. And what you see here is that network impact in general is correlated with payment activity. And so in fact, targeting institutions when they actually have higher payment activity will translate into, in general, a higher impact on the network. But secondly, private information regarding high payment days will also capture non-seasonal high impact days as well. And this is shown by the gray area, which is not only driven by, which has a broad representation of blue and red dots. So one way to see this here, we are seeing the incremental increases from a non-day to a seasonal to a top payment day to the maximum potential day on average of our scenario. And what we see is a significant increase as we assume that the information set of the attacker improves. So the theoretical maximum from using just public information to the maximum leads to up to 20 to 250% higher in terms of network impact. Now, so far we've assumed that institutions have not been responding to this cyber attack that has impaired, that has shocked an institution and is no longer sending out payments. But in reality, we might expect that due to abnormal payment activity, the system becomes illiquid. And anticipating this, institutions who are closely monitoring intraday payment activity will transition into a strategic self-preservation of liquidity. In particular, we're going to consider this other scenario where institutions are monitoring and can react strategically to hoard liquidity if they suspect abnormalities within the system. Our specific definition or cutoff is to consider a bank to be triggered when their counterfactual intraday payment deficit exceeds the bank's maximum deficit in 2018. Now, in some sense, the way in which we are assuming the bank's behavior is conservative. Here, the bank is only going to be triggered if the minute-by-minute level of payment deficit is greater than the greatest it achieves in the entire year of 2018. In some ways, we are also having a strong assumption that the bank is going to halt all of its payments. Now, regardless of this, what we are going to observe is that if a bank is triggered to hoard liquidity, it's also going to act just as though a shocked institution would. In this circumstance, the bank is going to start to soak up payments that it receives as a form of liquidity, and it's going to refuse to send out payments, acting as an endogenous black hole. So as more banks not directly affected start to soak up this liquidity, they can now potentially trigger a second, a third, and a fourth wave of institutions who are now also triggered to force to liquidity. And as a result, we can have a cascade effect with waves of institutions stopping their payment activity. Now, it's important to note that the effect that this has on network impact is a priori ambiguous. So on the one hand, banks that hoard are less likely to become impaired. They're going to start to soak up payments that other banks are sending their way without releasing payments, which means that their liquidity position will be improved relative to before. On the other hand, the second and third wave of institutions are likely to become impaired. And so the net effect is an empirical question. Now, what we find is actually that relative to the baseline scenario, where we did not assume liquidity hoarding behavior, the cascade scenario yields very similar results, with anything slightly amplifying the liquidity dislocation. So here on the plots, you can see the distribution of unweighted share, or the sheer number of institutions. On the right side, you can see the weighted share in terms of assets. And for both, you can see that there's largely the baseline and the cascade scenario distributions overlap. Now, an important caveat, though, is the fact that in this particular circumstance, now institutions more than ever are not actually sending out payments that potentially play an important role for real and financial activity. Now, in particular, the failure to facilitate these vital financial services necessary for the financial market and broader economy can have a devastating effect and a spillover effect. Now, here we're plotting the foregone value of payments from the shocked institution or the directly affected institution and these liquidity hoarding institutions, normalized by the average GDP per Fed wire day. And what we see here is, first of all, not surprisingly, that the directly affected institutions who are play a large fraction of the foregone value. But in general, even the net foregone transactions reach about an average of 3/4 of daily GDP. So far, we have focused on an attack on one of the top 5 institutions. Now, a real concern, however, is an attack that affects a common technological, has a technological commonality between multiple institutions. Now, we can reconfigure and look at an alternative scenario where we assume that an attack on a significant service provider has an effect on several large and medium-sized banks. Now, in this particular scenario, we examine, we find that actually there's a sizable effect that is greater than a shock or an attack on a single institution. So based on our estimates, we find that 60% of assets are impacted on average. And this is just to show or point out that with richer data on the technological commonalities between institutions, this can reveal hidden risks latent within the financial network. I want to go through the final exercise that we go through. So far, if it's not clear enough, we find that one of the top 5 being affected by or successfully attacked is enough to have a huge impact on the system. Now, from an attacker standpoint, an attacker will face a trade-off. Now, on the one hand, any of these top 5 institutions, or any large institution for that matter, has a potential systemic effect directly. But at the same time, these institutions have the resources and scale to invest into cyber defense. In addition to that, they face heightened supervisory standards of regulation, which means that they have much better governance practices and may be more resilient to a typical cyber attack. So an alternative track that a malicious actor might do is to target smaller, more vulnerable institutions and take advantage of the network interconnectedness. So one way to evaluate this is to think about the following question. What is the minimum number of small institutions to impair a single top 5 institution? So in order to do this, we're going to look at 2 different subsets of institutions. And the first is going to be mid-sized entities, or banks with less than 50 billion in assets. And we're going to also look at a similar scenario with small-sized entities, which are banks with less than 10 billion in assets. Now, what we find is actually a very surprising result. On most days, an attack on 2 or fewer banks within each group was sufficient to impair a top 5 institution. Now, this is a surprisingly small number of institutions, but what we actually find is that this reflects the branches of FBOs. So FBOs, relative to their asset size, send much larger values of payments. And this hints at the potential for there to be important implications in terms of ensuring cyber resilience. Now, just to conclude, here we provide in the paper a simple framework to assess vulnerability. And what we find is that the system is vulnerable to a crippling attack on most active banks. So one of the kind of important characteristics of cyber is the fact that it has intent. And what we show is that there is a huge sensitivity to the knowledge and information available to the attacker. And there are huge potential gaps in our understanding derived from vulnerabilities from significant service providers and other institutions that we don't have transparency over. Now, in terms of amplifications or channels through which a cyber attack can be amplified, we started with the effect it might have on dislocating liquidity. However, the next step is the implications on the payments and what the payments might have a role in for vital financial and real activity. In addition to that, we find that there can be a potential broad impact across geographically, looking into the interaction with banking market structure. Thank you.